Welcome back to the channel, and thanks for joining me. I'm Algabot, and in this video we're going to take a close, educational look at an expert advisor for MetaTrader 5 called the Thrust Imbalance Rebound Hedge. This is a pure price action approach, and it uses no technical indicators at all. Instead, it reads raw candle highs, lows, opens, and closes to find a 3-candle imbalance left behind by a strong thrust candle. By the end of this video, you'll understand how it spots that gap, how it enters on a rebound, and how its hedging idea works. Let's get started. So what exactly does this expert advisor do? At its heart, the Thrust Imbalance Rebound Hedge is built around a single, well-known price action idea, the fair value gap, sometimes called a 3-candle imbalance. When the market moves with conviction, a strong middle candle can leave a small, unfilled gap between the candle before it and the candle after it. This strategy measures that gap directly from the chart, with no moving averages, no oscillators, and no smoothing of any kind. Every decision comes from the candles themselves. The approach works on any symbol and any time frame you choose to attach it to, from major foreign exchange pairs like the euro against the US dollar to metals and indices. Because it reads structure rather than a fixed indicator, it adapts to whatever instrument you place it on, using a rolling average bar range to judge whether a gap is meaningful or just market noise. There are two ideas working together here. The first is continuation. When a fresh imbalance forms, the strategy waits patiently for price to dip back into that gap and then close in the original direction, treating the pullback as a rebound rather than a reversal. The second idea is inversion hedging. If price instead closes completely through the gap, the strategy treats that level as flipped, and an optional, separately tagged hedge position is opened in the new direction. Who is this style suited to? It's really aimed at students of price action and structure-based trading who want to study how imbalance concepts can be turned into clear rules. It is not a promise of any outcome. Think of it as a transparent framework for learning, where every threshold is visible and adjustable. Remember, all trading carries risk, and losses are a normal part of the process. Let's break down the mechanics step by step. The expert advisor acts only once per fully closed bar, so it never reacts to incomplete price action. On each closed bar, it keeps a rolling history of candles and calculates the average high-to-low range over a look-back window, set by default to 14 bars. This average becomes the yardstick for everything that follows. First comes detection. The strategy looks at the most recent trio of closed candles. The middle candle must be a decisive thrust, meaning its body fills at least the ThrustBodyFraction of its own total range, which defaults to 55%. For a bullish setup, the high of the first candle must sit below the low of the third candle, leaving a clean gap between them. For a bearish setup, the mirror is true. The low of the first candle sits above the high of the third. That open space is the imbalance zone. Next comes quality control. The gap must be at least the minimum gap factor multiplied by that average range, which by default is 1/4. This filter quietly ignores the tiny imbalances that appear during choppy, directionless conditions. Once a valid imbalance is stored, the strategy manages it before anything else. The continuation entry waits for price to dip back into the gap and then close in the thrust direction. For a long, the candle must tag the gap, hold above the gap floor, and close bullish. When all three line up, a buy order is placed. The stop loss is set just beyond the gap and the recent low, cushioned by the stop buffer multiplier. The take profit is then placed at a reward-to-risk multiple, defaulting to 2-to-1. If instead price closes fully through the imbalance, the gap is considered violated. With hedging enabled, an opposite position is opened in the inverted direction with its own stop and target, so an invalidated gap can become the next idea rather than simply a loss. Untouched gaps expire after the expiry bars count, keeping the strategy focused only on fresh structure. Let's look at the actual MetaQuotes language code that runs inside the expert advisor. At the top are the input parameters, the dials you can adjust in the settings window. You can see lots for position size, the ThrustBodyFraction that defines how dominant the thrust candle must be, the minimum gap factor that filters out small gaps, the take profit reward to risk ratio, the stop buffer multiplier, the expiry bars, the range look back, a switch to enable hedging, and the magic number that tags the orders. Below that are the two signal blocks. On the buy side, three conditions must all be true. The newest candle's low must dip back into the gap, its close must stay above the gap floor, and its close must finish above its open, confirming bullish momentum is resuming. When that happens, the entry price is the ask. The stop loss is placed below the lower of the candle low and the gap floor with a small buffer. The risk is measured, and the trade.by call sends the order with a take profit at the reward to risk multiple above entry. The sell side is a mirror image. The newest candle's high must poke back into the gap, its close must stay below the gap ceiling, and its close must finish below its open, confirming bearish momentum. The entry is the bid. The stop loss sits above the higher of the candle high and the gap ceiling plus the buffer, and the trade.sell call places the order with the take profit the same reward to risk distance below entry. Notice that both sides share one structure. Tag the gap, hold the line, close with momentum, then attach a structure-based stop and a proportional target. Now let's bring it all to life on this illustrative chart. Keep in mind these candles are drawn purely for teaching. They are not a real trade or a prediction. On the left, watch how the market builds our first setup. Price is drifting gently, and then a single, decisive candle pushes higher with real conviction. That is our thrust candle. Its body dominates its range, satisfying the ThrustBodyFraction condition. Look at the candle before it and the candle after it. The high of the earlier candle sits clearly below the low of the later candle, and that empty space between them is shaded as the bullish imbalance zone. This is the fair value gap the strategy has been waiting for. Because the gap is comfortably larger than the minimum gap factor times the average range, it passes the quality filter and is stored as a live imbalance. Now the strategy does not chase price higher. Instead, it waits patiently. Over the next candle, price cools off and dips back down into that shaded zone. This is the rebound the name refers to. The pullback candle taps into the imbalance, but importantly, its close holds above the gap floor, and it finishes as a bullish candle, telling us momentum is resuming in the original direction. That combination satisfies all three buy conditions at once, and the buy entry marker appears. Notice where the protective stop would sit, structurally just beneath the gap floor and the recent low, cushioned by the stop buffer multiplier. The risk is simply the distance from entry down to that stop. The take profit target is then projected upward at twice that distance, because the default reward to risk multiple is 2-to-1. From here, follow the candles. Price lifts away from the zone, prints a series of higher closes, and pushes steadily upward until it reaches the take profit target marker. That completes the long example. A thrust forms a gap, price rebounds into it, closes with momentum, and the position aims for a target measured against its own risk. Now watch the right-hand side of the chart, because the same logic works in the opposite direction. After the advance stalls, the market rolls over and a strong bearish candle drops sharply. Again, this middle candle is our thrust, its body filling most of its range. This time the low of the candle before it sits above the high of the candle after it, leaving an unfilled gap overhead. That space is shaded as the bearish imbalance zone, a fresh imbalance now sitting above the current price. The strategy stores this gap and waits for the rebound. A candle then rallies back up and pokes into the shaded zone from below. Its high tags the imbalance, but its close stays below the gap ceiling, and it finishes as a bearish candle. That is the bearish version of the three conditions lining up, and the sell entry marker appears. Structurally, the stop loss sits just above the gap ceiling and the recent high, again with the buffer added, and the risk is the distance from entry up to that stop. The take profit target is projected downward at the same 2-to-1 reward to risk distance. Follow the candles down. Price turns away from the zone, prints lower closes, and slides into the take profit target marker below. There you have the short example, a clear mirror of the long. Step back and you can see the rhythm of this strategy. It is always doing the same four things. Find a thrust, measure the gap it leaves behind, wait for price to rebound into that gap, and close with momentum. Then manage the trade with a structure-based stop and a proportional target. And if price had instead closed straight through a gap rather than rebounding, the hedging logic we discussed earlier would step in and trade the inversion instead. Every step is read directly from the candles, with no indicator anywhere in sight. That brings us to the end of our deep dive into the Thrust Imbalance Rebound Hedge Expert Advisor. We covered what it is, the fair value gap idea at its core, the exact buy and sell conditions in the code, and a step-by-step walk through both a long and a short example on the chart. We also saw how its inversion hedging idea aims to turn an invalidated gap into the next opportunity. Remember, everything here is for educational purposes only. It is not financial advice, not a recommendation, and not a solicitation to trade. All trading involves real risk, and losses do happen. If you found this useful, please like the video, leave a comment with the strategy you'd like me to break down next, and subscribe for more MetaTrader 5 strategy analyses. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.